Anyway, we've got a number of areas and questions we want to cover with Tony over the next hour, and the very first topic we were going to look at was actually to ask Tony how the department is organised, what sort of valuations they encounter, how many they have to deal with each year, and how is the department actually managed, and targets set and that sort of thing. So Tony, perhaps you could elaborate on those themes.
Yeah, no problem. First of all, good morning everybody. Tony Spindler here. So yes, well, I mean, in response to that question, I mean, I'm going to refer to shares and assets valuation as SAV throughout this, or SAV, but currently within SAV we have about 76 staff. We pretty much do as we say on the tin. Our role is to value shares and assets for tax purposes across the whole plethora of different spheres. We virtually value everything except UK land and buildings, which are valued by the VOA. So we will go from shares, intellectual property, bloodstock, chattels, a whole ream of things are considered. The business itself is actually organised into three areas. We have three assistant directors, of which I'm one, reporting to our business head. And they are basically labelled valuation groups 1, 2 and 3, with each one having a different function within the organisation. VG1, Valuation Group 1, is our complex case team, which is a group of about 10-11 valuers. They deal with predominantly the more complex valuation work that we see from large business. Their specialist area is around intellectual property and intangible valuation. So they get involved in a lot of sort of valuations that cross different tax regimes to do with things like transfer pricing, fair value accounting, and a lot of that kind of work. The second group, Valuation Group 2, is actually split into two functions. The first function is our service delivery team, which is the main administrative and processing hub of SAV. So that's sort of the engine of the office that keeps things ticking over in terms of the processing of the work, the admin controls, etc. And then the second part of that team is a thing called the Litigation Technical Advice Team, which in days gone by would have been known as our appeals team. Their role is effectively to act as our sort of litigation arm, and predominantly they will end up dealing with the cases where in the other groups, if things start to become contentious or old, or there's potential for litigation, it will actually move to that team, who will either seek to try and find resolution on the case or prep the case for presentation before first tier tribunal if we can't reach agreement. The final group is my group, Valuation Group 3, which is our general valuation team. This is our sort of main hub of values, and there's about 40 of us in that group. We will deal with the main bulk of the SAV valuation work, and but we also sort of specialise in employment share schemes. It's probably the main group that external agents and clients will deal with when dealing with SAV. So in terms of makeup, that sort of is our general structure. Over the year, in terms of valuation requests, we're fairly consistent on a year-on-year basis. We tend to receive about 14,000 valuation requests a year. They can be a mix of the various taxes, but the main areas are about a third of our valuations come from tax advantage share schemes. We get about 4,000 referrals for CGT, about 3,000 for IHT, and the remainder are the blend of other taxes, which can be things like stamp duty, income tax, fair value for accounting, as I mentioned earlier, transfer pricing. And another area where we've started to see a bit more work is valuation work for the HMRC Fraud Investigation Service, which is the new combined business of criminal investigations and specialist investigations within HMRC. So we do a lot of asset valuation work for potential criminal cases and confiscation cases, etc. When the work comes in terms of how we select cases and manage them, we operate a two-tier risk assessment process. So what we will do is, on our first tier risk assessment, our HO valuers, our risk assessment team, will actually try to identify those cases where they feel that the valuation is acceptable at the earliest possible stage, and we will try and basically use a filtering process to get down to the cases where we believe there are issues that need to be addressed and negotiations taking place. So what will happen is that they will make a review, and we try to do that within about 2 to 3 weeks to filter those out, the ones that we think that can be agreed. Ones that can't will move to the second tier risk assessment, which they're then allocated to a specific valuer, who again will perform their initial review to decide whether they can agree the case or whether the value is acceptable. If not, they will then engage with the agent or the taxpayer, depending on who's acting regarding that particular case. In terms of the final bit about the performance and how we measure it, our key performance metrics start at a business level and basically filter down through to team level and individual performance. Our main indicators relate around issues such as timeliness in dealing with valuations and correspondence, the quality of our work, and our key metric is yield contribution to the revenue as a result of the work we carry out. As with any business, we have financial targets in terms of the cost of both run and deliver yield to the revenue, and historically we run on about we deliver about £150 million additional yield per annum as a result of our work. In terms of quality checks, our work is we do actually do post timeliness, and what we try to do is deliver certain percentages so a correspondence is dealt with in either 15 or 40 days. Our targets on those things are we try to deal with about 80% of our posts within 15 days, within 15 days, and about 95% within 40 days. And again, we sort of tend to meet that target. So we like to think that we offer quite a good quality service to people and can deal with things as quickly as we can. We also have our own quality review checks of casework and individual cases. And what will happen is on a monthly basis there's a random selection of cases from individuals that are subject to quality reviews, both internally within SAV, so a manager will look at the cases, but also we have every 3 months an external quality review carried out by another quality assessor within HMRC. So they don't actually understand valuation, but they will understand case handling and how things have been addressed, etc. And they will feed back to us in terms of our assessments of that. And again, we do tend to be quite a high performing unit on that front. Finally, another thing we do, which I don't think is common within HMRC, but we've done it for a number of years, is we also carry out external customer surveys where we try to get feedback from the actual valuation community and people who have dealt with SAV about their experience of working with us. And I think, in fact, we've got one due next year. I think our next survey is due next year. And again, our experience of that is that people tend to, and I hope your listeners and yourself find us as a pretty good service, try to deliver the best we can for people. So, sort of in a nutshell, that's how we operate, and our structure and our key metrics.
Tony, earlier this year, your department withdrew one of its long-standing services, PTVC, and also best estimates for PAYE. Can you just tell us about, again, why that was done and what the sort of experience or maybe lessons learned have been from that?
Yeah, no, but I mean, firstly, I need to emphasise the fact that we do still operate a PTV service for capital gains tax and for tax advantage share schemes. So those services do still exist, so they can still be used by people. What has been withdrawn is the service for IT for PTVC and PAYE health checks. One of the key reasons for this was what we were finding. This is basically quite low risk work in terms of the tax at risk for the revenue. And more importantly, when we actually carried out our internal review, what we were finding was the vast majority of customers were actually getting things right. In recent years, as high as 95% of the cases that were being referred to SAV, we were actually agreeing the values as returned. It was therefore felt that we were sort of using considerable resource that would be better deployed tackling other risks. Further to this, the volume of work we were receiving was quite disproportionate to the amount of time being spent by valuers on reviewing these cases. At a high level, we were receiving probably around 650 IT per PTVCs a year and around 40 to 50 PAYE health checks. And as I say, in the vast majority of those cases, the values were acceptable. So it was the combination of these factors that led us to make a business decision to withdraw the service with a view to focusing more on helping the small minority that weren't getting things right, rather than just providing confirmation to the vast majority that were getting things correctly. However, one thing I would emphasise with this is that, as I said, people were getting this right and businesses were getting this right. And I think moving forward, if people continue to do what they were doing, and that is to use professional advisors and maintain the same approaches and thought processes they've done before, we see this as a sort of low risk in terms of losing the service because things were going well and people were doing things correctly. The main thing I think we've learned from the experience of this is the fact that it probably would have been better for us to have wider consultation with external bodies once we'd made the decision that we were going to do this. I think we sort of talked about it for a while at things like the Fiscal Forum, etc. But when we actually made the decision, it was a direct decision by SAV. And I think the experience I've definitely learned out of this from the feedback we've received is that in future, if we're going to look at anything like this, it's probably better to come to the table with external bodies before and explain what we're doing and why, and then try and make you understand and discuss that with you to see if you can appreciate the reasons behind it before we actually go ahead and implement things.
Tony, I mean, with the withdrawal of the PTVC, which was used by about 650 occasions before it was withdrawn, typically in a year, how now should taxpayers, or particularly the companies that set up these share schemes, seek to provide or obtain certainty about the valuation at some point? What do you think they should do? How do you think they should deal with their tax returns in particular?
I think the first thing I have to say there is, as I just mentioned, for CGT and tax advantage share schemes, the facility is still there. So that can still be utilised and you can still have discussions with SAV. In terms of the non-advantage schemes, I think that the reality is once a return has been filed and is in the SA process, we actually at that point can't say we can provide assurance that that value is going to be acceptable. If the value is identified as a risk and SAV feel the value should be challenged, we will advise the instructing office or we will contact the relevant agent and we will take that forward. However, I have to go back to the point I was making earlier that I would stress that the risk can be mitigated by using a reputable, professional firm or individual that can provide a valuation advice. Now, as we saw in the ITPA PTVCs, the vast majority of people were getting things right. So, in my experience and my view, that when we go out to meetings, etc., people, when they talk about the sort of hypothesis and case law relating to fiscal valuation, it can often be a very difficult and quite surreal area for inexperienced people to understand. So in using a sort of professional or knowledgeable firm or individual, you have that benefit of someone that hopefully can explain it to you and make you help you understand that, and also they will understand the valuation issues and risks that maybe sort of arise out of whatever transaction you're considering. So I think that itself would help reduce the risk of errors being made and also provide a form of assurance and certainty that what is being produced, it will be correct and hopefully won't be challenged by HMRC. In terms of the second bullet point about what a taxpayer needs to do to include in a self-assessment tax return, I would direct people to the gov.uk website. SAV provide share valuation guidance, and if you go to the gov.uk and just type in on the search share valuation guidance, you'll be linked to a document that actually sets out our sort of expectations about what people should disclose, what sort of information they should provide. However, usually what we would say to people is we would expect probably 3 years previous accounts, some sort of context behind the transaction itself and what was going on, and also information about any potential offers that may have been for the business, or potentially any offers that may be being made for the business in the future. I think the problem is that once you get into valuation, the first thing you realise is each case is unique. So it's difficult to give a sort of high level, this is what is required, because the dynamics of cases will alter on a case by case basis, as no doubt we would explore later with some of the questions.
Okay, Tony. Of course, with share valuations, the reality often is that while we need a single figure for tax purposes, we all know that the valuation there's really a range of potentially acceptable values, a spread, and in particular, I was going to ask you about best estimates, because there the taxpayer is under quite a lot of time pressure to arrive at a value that they can use in order to calculate the PAYE that may be due. And now that we haven't got the opportunity to agree that or validate that through a process with HMRC fairly shortly after the tax is paid or due, that does raise a question, I think, about the level of relative accuracy that a best estimate might have compared with a normal valuation, and whether there is a difference, and whether HMRC recognise that and have any views on how that should be handled.
Yeah, I think the one thing I would say is that the very nature of the fact that you've got a separate sort of categorisation from best estimate and valuation in itself clearly, to my mind, sets out that there must be a difference. At a high level, I accept the point actually made on the slide. They are likely, or there is a possibility that they could be less accurate. However, what I would say that from our perspective, from a SAV perspective, there would be an expectation that the best estimate is a reasonable attempt to actually sort of arrive at a value, and that reasonable efforts have been made to gather information relevant to the exercise, so that any value that is presented is an informed decision rather than just a pure speculative figure. That said, I think you're right, and SAV do recognise, and I do accept, that for best estimate purposes there could potentially be a reason why it would be less accurate, and we wouldn't have an expectation that it would be the exact number or figure that would be presented if you were to do a full-blown valuation. Because as you say, as you move later on, you may have time to consider it more, they'll be able to have more discussions. The time limit itself does put pressure on people, so we're not looking for a right answer. What we're looking for is that reasonable attempts and a reasonable expectation and level of information has been used to arrive at a figure. And I think if that's been done, I would see that as okay.
Okay, that's very helpful. Just on this theme of guidance, we all know that every valuation is unique, and with the opportunity through PTBC to have the revenue look at valuations relatively soon after the transaction occurred, having got non-tax favoured awards disappeared. I know one of the things HMRC is keen to do is to perhaps develop some more guidance that external valuers could and their clients could look to in some of the more sort of subjective areas. I'd be interested to know your views on what you might be able to, how far you might be able to go in terms of giving guidance on discounts for minority holdings, for example. Another area that often crops up is pre-IPO discounts. How far away are you from a float that may or may not happen, and what sort of discount might be appropriate. And also something that often crops up, and I think is quite important, is early stage technology companies, where these often have funding rounds where either business angels or private equity or large companies take a stake in the business to help them get to the next stage, and all of that funding is earmarked for use in the business, and whether that actually is a good benchmark for an IT valuation necessarily. Again, that's something where I think I'd be interested to know whether there's any guidance that HMRC can look to give on that.
Yeah, the one thing I did refer to the share valuation guidance on gov.uk, and actually within that there are a range of scenarios around possible valuation issues which actually do cover pre-IPO and early stage startup tech companies. So it's worth looking at that in the first instance. I think the other point you touched on, William, was about guidance, and you are right. I mean, following the withdrawal of the ITPA PTVC, we are currently trying to work with external bodies to try and establish whether, what form of guidance we could produce that would assist people. But I would say that, from my view, that's a collaboration thing. I don't think that HMRC can come out and say to you, this is what must be done, because we all know valuation is subjective. We all know it's a matter of opinion. I often say to people, and I'm sure that people in the valuation community would agree, if you put 4 valuers in a room, you're going to get 4 different answers. So, I don't think it's something where we can say to you, this is right and this is wrong, which is why I think collaboration is key. It's key that we do communicate, and hopefully through that sort of discussion, ongoing discussions with those bodies, we can look at what we can produce around guidance. In terms of discounts themselves, historically SAV did publish sort of guidance around issues such as minority holders and gave indicative ranges, etc. in our former manual. However, I think in my experience, over the past 5 to 10 years, the valuation landscape has altered significantly. So I now think it's difficult to set out what would be a sort of direct tolerable range of discounts. In days gone by, you go back sort of 5, 10 years, SAV would have been seeing a lot of work of family-controlled companies where we're valuing a minority shareholding. So the prospects of an exit, were far removed. They may be sort of looking at being tied in for 10, 20 years because of that family control and the risk about being able to sort of realise their investment. However, these days, and as you touched on, the dynamics of investors has altered considerably. We now see a lot of cases where there's some form of business angel or there's a PE house involved. So as such, there may be genuine expectations why a minority purchaser may have different views and beliefs as to the likelihood of a return on their investment. But ultimately, it's going to be down to the particulars of a case. So I think it's very hard for us to say that, there is a tolerable range. If you look at things like funding rounds, the first thing that sort of springs to my mind, it's going to be a question of fact. We talked about the fact, you mentioned that the funding will be for working capital purposes. We'd need to look at factors like the burn rate of that. What is the likelihood? Also, I think, at what stage is that funding? If you're on a first round of funding and you've got people putting money in, it may be a speculative punt for them in terms of, we hope this works, but we don't know, but we're willing to have a go. Now, at that point, I would say there's considerable risk there. But if you're looking at a third round of funding, equally there's still risk there. But if people are still coming back to the table and still willing to put money in and invest, are we saying that actually the product or the service is evolving, is developing, and they've got confidence that something's going to happen? So, I think the problem is you have to go on a case-by-case basis, and it's difficult. I mean, my own view, and one that I firmly believe, is that transactional analysis must set the tone for what is or isn't acceptable as a discount. On the actual guidance we produce, they talk about an early stage tech company and a discount of 30% for the funding round price being acceptable. My concern with that is, it may tend to lose sight of what motivated that funding, who invested and why. Before we came on air, we were talking about business angels. A business angel's motivation may be very different to a PE house's motivation. So I think the key thing for me about this is the context must set what we consider to be a reasonable discount. And my concern is, if there's a particular danger, if we go out setting, if HMRC would produce guidance setting, particular ranges, etc., it in a way sets a form of expectation. Regardless of the circumstances, people may just look at that and consider it to be, that's the framework of what is tolerable. And even if we caveat that this is pure guidance and it depends on the particular facts of the case, there's still going to be that risk that people would perceive that range as acceptable and therefore lose sight of setting the context of the transaction and arrangement. So I think it's a difficult one. I think it's one where we may, well, in fact, I've got no doubt we will end up exploring this when we have discussions around what guidance we can and can produce with external bodies. But it's one where, from my own point of view, I have a reluctance to say that there is an acceptable range, because I think we have to encourage, both within SAV and externally, our values to think about context and delivering context. And if you don't understand a transaction, it becomes just effectively a sort of valuation by numbers, which I think is a risk. People really need to understand and appreciate what they're doing and why they're doing it. And I think at that point, it's only then you can really decide what would be appropriate in terms of a discount rate.
Something that perhaps does lend itself to a bit more of a specific answer is the next question we got, which was on quoted companies, where it would just be helpful if you perhaps could remind us where HMRC's current thinking is in terms of sort of averaging of prices over a period of time.
Yeah, no problem. I mean, I'm going to sort of give you a bit of a techie bit here, but in terms of the positional quoted shares, this is actually set out. You can actually go to the Shares and Assets Valuation Manual on gov.uk. If you look at SVM 107080, that actually sets out quite detailed guidance about the consideration of quoted shares, etc. In terms of sort of the AIM market, again, we do have general guidance on SVM 110070 on considering the value of AIM shares. However, in a way, with the AIM shares, they aren't recognised as quoted or listed for tax purposes, so we are back into sort of like the consideration of open market value. And I would have to say it's again dependent on circumstances. In most cases, what HMRC or what SAV have said is that they will accept the closing prices listed in the FT on the date of grant. However, there is a caveat within the arrangement about special circumstances. And I would say with special circumstances, you could be looking at the results. You know, there may be a concern about the shares being thinly traded or it being a stale market, or actually in some cases that we've seen at the moment, the potential for the use of the market for avoidance purposes. So in those special circumstances, we may seek, or you may seek, to offer a different value, such as averaging. Now, at the moment, the general rule we have within HMRC is we don't tend to look at more than a 3-day average. We will accept a 3-day average where people feel there are circumstances that merit that, and where, as I say again, you know, whether that's down to stale market or sometimes it might be down to just sheer volume and shifting of the shares. But we do sort of generally consider where special circumstances allow up to a 3-day average. But I would emphasise that, you know, that isn't set in stone. I think individual circumstances may mean that there are potential genuine reasons why that wouldn't be appropriate. As such, I think the only way we can really sort of say is, if you have those special circumstances, it's about collaboration, it's about talking, explaining to us why, us listening, us trying to understand, and between us trying to sort of figure out what is reasonable and coming to a common consensus on what would be appropriate in that particular case. Finally, on quoted companies, I think people may or may not be aware that we do actually list all shares and securities that were firmly quoted on the London Stock Exchange, which have officially been declared negligible value on gov.uk. And again, if you just go to the share valuation pages, there is a link there for the NegVal list. So people can get an up-to-date sort of cover of the current previously quoted companies that have gone negligible value.
Another area we had a question on concerned what is sometimes called John Lewis economy type companies. There was legislation in Finance Act 2014 to encourage businesses and the owners of businesses and their advisors to consider a ownership structure for companies that is akin to the way John Lewis is structured, and indeed a number of other companies have been structured in that way for quite some time. The idea here is that instead of shares being owned directly by individuals or other parties, the shares, or at least a controlling majority of the shares, would be held and owned for the long term by a employee benefit trust, or employee ownership trust as it's called, which would hold those shares for the long term benefit of employees on a collective rather than an individual basis. Now, the legislation permits, alongside that majority controlling ownership by the EOT, continued individual share ownership. It also permits the award of share options, including tax-favoured EMI options, and there's a specific exemption in the legislation that normally you wouldn't be able to have EMI options where there's a controlling corporate body, which the trust is normally structured to be, but there's a specific exemption that allows EMI options. So this has been something that was thought about and incorporated in the whole package of legislation that came out in 2014. So I think one of the questions we've had is, does that create any sort of special circumstances as regards the valuation of shares that would be potentially used for the satisfaction of options? I mean, just putting the question in specific terms, I mean, one could envisage valuations being needed for EMI options purposes and applications being made for that. It raises the thought, and do you just value those shares as if it was part of a normal unquoted company, disregarding the very unique ownership structure, or does that have an impact on the valuation, and if so, how might it have an impact?
I think it's a really good question. I mean, one of the things we don't actually do EOT valuations per se, but as you say, the circumstances of this case where there is the potential for EMI, it's something that has been flagged up, but we haven't actually seen it as a valuation issue yet. But in my mind, I mean, I think one of the key dynamics in open market valuations, and it's an accepted principle, is the notion that the purchaser and vendor are hypothetical, but everything else is real. Now, allowing for this, I think there has to be recognition that if there was a trust acting as a market maker and providing an exit route using a defined basis for calculating value, etc., it has to be recognised if that opportunity is truly open to all shareholders. So, I think at a high level, the existence of an OET operating in a certain way could well have implications for a valuation exercise, because we are back to that reality that, if everything else is real, they are there. They are in the makeup of that company. They are there potentially offering a predefined exit route, and any vendor or purchaser of that particular holding we're valuing would be aware of that. And if it influences value, I think we have to consider it. I think the problem would be that until you get down to the specifics of the case, you wouldn't know just how influential that is. But I think at a sort of, at a sort of general level, yes, I think it must have to sort of influence it.
So taking the particular example in the second bullet point, if the articles of the company that was employee owned by the EOT said that, and there was an agreement in place between the trustees of the EOT and that they would have to buy shares at, say, an undiscounted market value rather than a discounted, as one might normally do for a minority interest. And that was sort of hardwired, so to speak, into the whole structure through the articles, maybe. Would you regard that as a factor that would influence you in deciding?
It's one where, in all honesty, I don't think I can give a direct yes or no. I mean, the first thing I thought about is one of the things often in fiscal valuation, when we're considering the open market scenario is, and through case law, we've learned that the idea is that you're standing in the shoes of the purchaser, and you're looking outside of the articles in terms of etc. So for the purpose of the valuation, we're standing in the shoes of the purchaser outside the articles. Once they have the shares, they are then bought by the articles. But I think, to my mind, the first point I would consider there is, what are the expectations of the shareholder enhanced by the existence of the EOT? As I said earlier, if it does offer a predefined exit route, and that is available, a price available, and an option available to every shareholder, to my mind, I think we would have to consider how it would approach or how it would impact. And again, to my mind, I think it must have an impact on discount. And it may be to the point where, if it is truly open to all and everybody has that reasonable expectation that they can find an exit via that EOT at a predefined price, and that in effect is setting a market price because everybody can exit that, maybe the answer is there is no discount because everyone would have that expectation and everybody would be privy to the same privilege. But again, it's got to be on a case by case. I'm sorry about this, but I think as you covered in one of your slides, sort of every valuation is unique. But I think at a high level, there's a point there, and I think the point is correct. If it is influencing the overall position of everybody, it's difficult to disregard it, because the reality is it's an option and an potential exit route open to all.
Sort of related, but not the same, because we're not now dealing with an EOT structure with collective ownership, but again, an employee-owned company where there is an internal market. Now, there's a specific question that's arisen, and I perhaps need to put it in a bit of context for the rest of the audience, which is that you have a company where the shares are owned by the employees. There's a large number of them. Former employees can also continue to hold shares. There's a trust in existence which acts as a market maker and holds maybe a quarter of the shares, and so buys and sells and allows various other forms of employee share scheme to operate. But employees and shareholders, who might be former employees, are allowed to transact between themselves and reach arm's length deals. The trust itself also wants to have a store of shares that it can use to satisfy future equity awards, and therefore, particularly when a retired employee wishes to realise their shares, they're often quite keen to take advantage of that to bring the shares back into the employee side of the ownership structure. So you can get in that situation quite a wide range of share values, even in a short period of time, because it's an internal market, but there are a lot of transactions going on with different parties involved and different prices. And I mean, the question that raises is, share valuations tend to be a single number. How do we manage the situation? How can one sensibly look at that?
It's a difficult one. I mean, I think this is a scenario again. The facts of the case will drive how we ultimately look at it. However, I would say as a general point, I would accept that if the transactions within that internal market were on a genuine arm's length basis and there was clear evidence that the parties in respect of the transaction was sought independent advice on value, then to my mind HMRC would be limited in its ability to challenge those values. I mean, the one thing we have to remember here is that the ability to impute market value on a transaction set out in, I believe, section 17 of TCGA. Now, that basically covers the fact that if it is a bargain at arm's length, HMRC are not in a position to consider a market value. Now, in the scenario you set out, the one thing we have to accept in the real world is that people do make good and bad investment decisions. Some people are, as you say, some people's motivations for price will be different to others. But if it's a genuine transaction between people at arm's length where they have acted independently, I think we're in a position where we can say that is a bargain at arm's length. And whether it be a good bargain or a bad bargain, that's just a reality of life. I may be able to convince you, because I have experience in share valuation, that a share is worth £1. Someone else may come along with limited experience and may be only able to convince you that share is worth 70p. Now, if we've both had independent advice and you're working on your best judgment and you're happy to pay that £1, I think that if it is a genuine bargain at arm's length, it has to be £1. So it's a difficult one. I think where it would get a bit more interesting, you talked about the trust acting as a sort of market maker. I think from an SAV perspective, my concern would be about the consistency with that. I think, as I mentioned earlier with the EOT, and I think it probably falls same true, if we saw a trust that was operating on varying levels and offering different prices to employees, I think we would have to question, well, how does that work? Where's the consistency? Where's the fairness? And at that point, would we be seeking to challenge? But I think with this particular question, we're moving into a sort of blend of technical consideration and valuation consideration. We can debate and discuss value around that, but I think the first thing would be the technical point of, is it something where HMRC has an ability to challenge in the first place? And in line with section 17, if we have a genuine bargain at arm's length, and it's clear evidence there has been that form of separation between the two and form of consultation independently with advisors or whoever they thought, I think that, in my mind, HMRC would be limited in its ability to challenge that.
Fair enough. We're coming towards the end now, but one thing that would be very helpful, Tony, if you could sort of get your crystal ball out a bit and see how you anticipate shares valuation, and particularly HMRC, moving in the context of the tax digitisation, which is obviously a very, very big thing,
Yes.
and will change a lot of things over the next few years and beyond. And just where do you see that going?
In fact, I'd say it's not where it's going, it's where it's gone, because SAV have actually already moved to, we actually now do our valuation work electronically. We actually last month moved to digital valuation. So I think it started for us, and the reality is that HMRC is moving to a digital agenda. I think that's just basically in line with the times. That's the reality of the way people expect to be able to sort of do things now. It's a bit like the banks. Gone are the days where you go into the bank now you go online, and that's what's happened with the development of the personal tax account. The idea is to create that one-stop service that provides an easy and meaningful way for people to deliver. So I think it's already here. It's going to evolve moving forward, and I think that SAV have already sort of embraced that, both internally with our digital filing, but also hopefully agents will have seen that we're definitely being a bit more sort of proactive through a thing we've developed called proactive caseworking. This is something that we started last year, but what we will do now is that at the beginning of a valuation we will actually contact to introduce the valuer to the customer, to sort of explain that they will be the individual dealing with it. We will then sort of try to sort of correspond via email to sort of speed up the process of the service. So internally, I look at it two ways. From an internal perspective, the impact is huge on SAV with digitalisation, because we are an office that historically has been paper-based. We are predominantly paper-based. So the transition over is massive in terms of the amount of information we hold on our files about valuations that we've conducted in the past, and also need to retain, because we need to remember that CG base date is still March 82, so we have to retain information for precedent, etc. And also we have a lot of information around market information in general and sector specific information. So I see that being a big impact for us. However, I think for external customers, the benefits of digitalisation with SAV will hopefully mean you're getting a more engaging and collaborative service that's quicker, hopefully more efficient, and also more meaningful to you, because you're actually developing a real-time relationship with the valuer. In having in being more proactive and using things like email and encouraging our people to pick up the phone, it becomes a sort of better experience for you. In terms of sort of case selection, HMRC has a lot of information sources, a lot of electronic information sources, and what it's currently trying to do is bring that together into a thing called the Big Data Hub, which we believe that once that's done, we will have probably one of the most powerful information IT sources in the UK, actually, in terms of information that's available. So we're confident that in terms of sort of our risk profiling and our ability to identify issues, we will be able to do that digitally and efficiently, and hopefully we will then move on to sort of, in terms of the customer, the ethos of HMRC is the customers that are getting it right, we want them to have a quick and easy experience, and it should be that way. And I would say from a valuation perspective, the vast majority of our customers will fall within that bracket. For the customers that aren't getting it right, we want to educate them and make it easier, and through things like guidance we can do that. For the customers that are seeking to avoid we believe that with things like the big data hub, etc., we will have the digital capability to identify those risks, and that's where we want to devote our time and resource to tackling those sort of issues. So yeah, I think sort of really the thing about digital for me, it's more about pace. I think it's going to offer us a pacier, more effective and more efficient service, and hopefully, you know, external reps and external taxpayers will actually hopefully benefit from that and feel that they're getting a quality service quicker, more effectively, and also more collaboratively as well. But, you know, that's a big thing for me. I think that, as I said earlier, we deal in a subjective area, so I would rather we work together than work against each other, because if we work together, hopefully we can find ways to resolve things, or find ways, you know, we're not going to agree on everything, but at the end of the day, I think reasonable people can have reasonable discussions about things, and that's the way we should work. So,
indeed, that's something one certainly wants to encourage. Just one final question, which is a little bit of an old chestnut, but
you've been here before, haven't you?
I think it's just worth asking you again. It's sometimes suggested that one way of resolving the conflicts of strain on HMRC resource and the desire to give certainty would be a pay-to-play system for non-tax favoured schemes. Has any thought been given to that?
Yeah, it has. I think the main point here is that, you know, our concern is to offer a payment system would in effect create a two-tier system. HMRC is required to treat all taxpayers equally. So if we provide such a service to those who were both willing and able to pay, it could be seen as giving preferential treatment to a small group of individuals. I think the other side of it as well, that from an internal perspective with SAV, I have a concern about the administrative burden of that in terms of case handling for our valuers and how they deal with things. As a paying customer, I think, you know, it would be understandable that they may have enhanced expectations of being treated differently to others. You know, they may have an expectation that their case should be prioritised, or they need to have that valuer's time more than someone else because they're paying for that service. But our valuers have to deal with every valuation they see. They can't just put things to one side. And I think if we had this sort of system, it would create, one, an imbalance. It wouldn't be equal and fair to all. Two, it would create a burden, as in how would we handle it? Where would we prioritise our workloads? How would we sort of like have that clear demarcation between how we handle paying customers and how we handle non-paying customers? And I think finally, you know, the other thing as well is that if we open this up for valuation, are we then going to get other areas, pensions, self-assessment returns, where people say, well, actually, I would like to pay for a service to have an enhanced experience or a better experience. And again, it's not a fair and consistent experience for all, because some people are willing, some people are able, other people are willing but not able. And if they can't do it, it's unfair that we can offer it to people that can, to the detriment of them. So I think it's more for me about consistency and fairness across the board. So yes, it is something that has been put to us, and it's something we have actually considered, but I don't think it's something that we can viably say would work.
Okay. Thank you very much, Tony. I hope everyone's found that as interesting as I have, we are making a recording of it, so that will become available before too long, and we'll notify people who are listening and who registered when that is available. Once again, I'm sorry we started late. That has rather reduced the opportunity for questions, but if you do have any questions, please, by all means, send them to me. And Tony has said that he'll be happy to look at them.
I'm happy. If anybody's got any questions, I'm happy to pick them up with you, William. And thank you very much for your time, everybody. Thank you.
Thank you.